Confidence is necessary for any trader. Without it, no one would take a risk, enter a market, or make a decision. But when confidence grows faster than accuracy, it becomes illusion. This is the overconfidence trap, the tendency to overestimate knowledge, skill, or control in unpredictable situations. The concept was first explored in the 1970s by psychologists Daniel Kahneman and Amos Tversky, pioneers of behavioral economics. Their research showed that people are systematically poor at judging probability. When asked to estimate their own accuracy, individuals consistently rated themselves higher than results later proved. Confidence rose, even when performance did not. In financial markets, overconfidence turns uncertainty into perceived control. Traders believe they can predict short-term movements, time entries, or identify hidden patterns others cannot see. The mind mistakes familiarity for understanding. Exposure to charts, news, and analysis gives an illusion of expertise, but not accuracy. This illusion is magnified by what psychologists call the illusion of control. In experiments, people who rolled dice themselves believed they could influence outcomes, even though results were random. The same illusion appears in trading, where personal involvement, clicking a buy button, studying charts, feels like control over chance. A key study by researcher Terence O'Dean examined thousands of brokerage accounts and found a clear pattern. Traders who traded more frequently earned less. The reason was not bad luck, but misplaced confidence. They believed they had superior information, when in reality frequent trading simply increased exposure to errors and costs. Overconfidence often grows after success. A few profitable trades reinforce the illusion of skill. The brain confuses luck with ability. This is known as self-attribution bias, the tendency to credit wins to skill and blame losses on external factors. Over time, this cycle inflates risk-taking and erodes caution. Studies from finance professor Brad Barber showed that male traders displayed higher overconfidence than female traders, leading to more frequent trades and lower average returns. The research suggested that humility, not aggression, preserved capital. Caution, in this case, was a competitive advantage. Modern trading platforms amplify overconfidence through design. Instant order execution, mobile alerts, and real-time performance tracking create a sense of immediacy. The user feels powerful. The interface reduces the perception of risk while increasing engagement. What once required deliberate planning now happens with a tap. This ease of action shortens reflection time. Each trade becomes another moment of perceived control. Psychologists describe this as reinforcement learning. The brain rewards itself for taking action, even when that action has no measurable benefit. Trading transforms into behavior driven by repetition, not evaluation. Overconfidence also distorts how traders remember outcomes. Losses are often reframed as learning experiences, while wins are stored as proof of skill. This selective memory protects self-image but damages performance. Real growth requires confronting uncertainty, not denying it. Markets punish certainty. Every participant faces the same uncertainty, but those who acknowledge it adapt faster. The overconfident trader resists feedback, ignoring warning signs until losses become undeniable. The cost of overconfidence is not just money, it is the inability to learn. Overconfidence does not exist in isolation. When enough traders share it, it begins to shape the entire market. Rising prices create the appearance of skill. Each participant believes they are part of a collective insight. In truth, they are part of a feedback loop where confidence builds confidence, and analysis gives way to imitation. Behavioral economists describe this as representativeness bias. When people see repeated success, they assume it represents skill rather than chance. In markets, this means a string of profitable days convinces traders that patterns exist, even when the data shows randomness. Confidence replaces caution, and the cycle continues until the pattern breaks. This bias is often supported by selective storytelling. Financial media and online forums amplify successful trades and silence failures. This creates a distorted sample of reality. The overconfident trader compares their performance to a public highlight reel rather than the market itself. The result is an inflated sense of personal ability. Another force sustaining overconfidence is outcome bias. This occurs when people judge decisions by results instead of reasoning. A trade that profits appears smart, even if it was based on poor analysis. Over time, outcome bias trains traders to trust luck, not logic. The market rewards risk takers temporarily, but punishes them eventually. Overconfidence also alters how traders perceive risk. Psychologists call this optimism bias, the belief that negative events are less likely to happen to oneself. It creates a false sense of immunity. Traders accept greater leverage or larger positions because they believe skill will protect them. The more they succeed, the stronger this illusion becomes. Market bubbles form when collective overconfidence reaches its peak. Rising prices appear to confirm belief, creating what economist Robert Shiller calls irrational exuberance. The higher the market climbs, the more it seems invincible. Each new participant enters convinced they are early, even as the structure begins to weaken. When markets fall, overconfidence does not disappear. It often transforms into denial. Traders cling to losing positions, convinced that recovery is imminent. This is linked to confirmation bias, the tendency to seek information that supports existing beliefs. They filter out warnings and highlight any detail that suggests hope. The emotional impact of loss reinforces the trap. Research by Kahneman and Tversky demonstrated that losses feel roughly twice as powerful as equivalent gains. This asymmetry makes overconfident traders double down instead of stepping back. They trade more aggressively to win back losses, deepening the cycle of risk. Technology intensifies this cycle. Algorithmic trading, leverage access, and social trading platforms reduce friction and delay. Speed encourages confidence. Traders experience the illusion of precision through data dashboards and analytics tools. But the more precise the numbers appear, the greater the illusion of control becomes. The final stage of overconfidence is rationalization. When losses occur, traders reinterpret them as temporary setbacks or external interference. The pattern repeats, fueled by a belief that failure was caused by timing, not judgment. In this way, overconfidence protects self-image while undermining performance. Markets reflect psychology more than mathematics. Price movements are not purely data-driven, they are human-driven. Overconfidence, optimism, and selective attention combine to create predictable cycles of boom and correction. The same mistakes reappear under different names, carried by new technology but powered by the same human mind. The first step in avoiding overconfidence is accepting uncertainty. Markets are complex systems influenced by thousands of variables beyond any individual's control. Psychologists describe this as epistemic humility, an understanding of the limits of one's knowledge. The best traders do not predict. They prepare. They build strategies that can survive being wrong. Professional investors use process to protect themselves from illusion. They rely on structured decision-making instead of instinct. Written trading plans, position limits, and checklists remove the need for confidence in the moment. This is sometimes called a decision architecture, a system designed to keep emotion and bias outside the trade. Another safeguard is keeping accurate records. Behavioral finance researchers have found that traders who review past performance with honesty reduce bias over time. The act of journaling transforms experience into evidence. It forces the trader to confront patterns of overconfidence and identify which decisions were based on skill and which were luck. Diversification is not only a financial strategy but a psychological one. By spreading risk across assets, the trader limits the influence of single decisions. It creates a barrier against the illusion of certainty. Diversification forces humility by showing that no one idea is guaranteed to succeed. Slow thinking also acts as a defense. Psychologist Daniel Kahneman described two systems of thought, one fast and intuitive, the other slow and deliberate. Overconfidence thrives in fast thinking. Slowing down allows analysis to replace instinct. Time creates distance between impulse and execution. In trading, patience is not hesitation. It is control. Feedback from others provides another layer of protection. Discussing ideas with peers or mentors introduces external perspectives that challenge assumptions. Social accountability exposes blind spots. It transforms trading from a solitary pursuit into a shared analysis. Confidence becomes calibrated through conversation. Technology can be used wisely by introducing friction instead of removing it. Some professionals implement time delays between decision and execution or require confirmation for large trades. The brief pause disrupts impulsive behavior. The moment of reflection becomes a circuit breaker that prevents unnecessary risk. Education also reduces overconfidence. Exposure to behavioral finance, probability theory, and market history expands awareness of human bias. The more a trader learns about how the mind distorts judgment, the more likely they are to adapt. Knowledge does not eliminate error, but it narrows the margin for illusion. True confidence is quiet. It is built on evidence, not impulse. The most successful traders are not those who believe they are always right, but those who know they can survive being wrong. They view each trade as one data point in a lifelong experiment. The goal is not to win every position, but to improve every decision. The overconfidence trap cannot be fully removed, only managed. Awareness is the key. Humility keeps ambition from turning into delusion. In markets, as in life, control is temporary and knowledge is partial. The trader who accepts that truth trades with a clearer mind. Uncertainty stops being a threat and becomes a constant companion, a reminder that mastery begins with doubt.